Today, we're diving into underwriting and financing of residential properties. This process is all about how lenders assess borrowers, evaluate the risks associated with the property, and structure the loan from the initial application all the way through funding. At its core, residential lending hinges on three key elements coming together: the borrower's financial strength, the quality of the collateral, in this case, the property itself, and the current market conditions. Understanding how these factors interact is essential for making sound lending decisions. Over the next 27 slides, we'll cover the essentials of underwriting to give you a clear, comprehensive view of this important process. Underwriting is a crucial process where an application is transformed into a credit decision. It involves three main steps. First, there's the assessment phase, where we gather detailed information about the borrower, their income, assets, and property involved. Next is the analysis phase, where we evaluate the borrower's credit strength, the value of collateral, and their ability to repay the loan. Finally, we reach the decision stage, where the application can be approved, suspended, or denied based on the documented risk. This structured approach helps ensure that financing residential properties is both thorough and responsible. When we look at residential financing, there are four key players involved, each playing a crucial role in assessing and managing risk. First, we have the borrower. This person provides essential information such as income, assets, credit history, and their intent to occupy the property. This data forms the foundation of the loan application. Next is the lender, who takes on the responsibility of structuring the loan. The lender evaluates whether the application meets specific guidelines and requirements, essentially deciding if the loan can proceed. Then we have the appraiser. Their job is to estimate the current market value of the property. This step is vital because it confirms whether the property value supports the loan amount requested. Lastly, the title company comes into play. They verify the legal ownership of property and check for any liens, claims, or defects that might affect the transaction or ownership rights. Together, these players each validate different aspects of risk to ensure the financing process is both secure and reliable. Let's talk about the fundamentals of credit scores and why they matter, especially when it comes to underwriting and financing residential properties. Credit scores typically range from 300 to 850. Scores below 580 are generally considered poor. Between 580 and 669 is fair. 670 to 739 is good, and 740 and above is excellent. The critical threshold to keep in mind is between 670 and 739. This range is really important because it's often where you'll start seeing better pricing, more flexible approvals, and lower reserve requirements. In other words, once your credit score hits around 670 or higher, lenders view you as a stronger candidate for conventional loans. This common benchmark plays a key role in securing better financing terms. So maintaining or improving your credit score can have a big impact on your loan options and costs. When lenders evaluate your mortgage application, one of the key factors they look at is your debt-to-income ratio, or DTI. This ratio is essentially a measure of your monthly debt payments compared to your gross monthly income. The formula is straightforward. Your total monthly debt divided by your gross monthly income equals your DTI ratio. A lower DTI ratio is better because it shows lenders that you have more financial flexibility to handle a new mortgage payment. Typically, lenders use two standard thresholds. The front-end ratio should be no more than 28%, which includes just your housing costs like principal, interest, taxes, insurance, and homeowners association fees if applicable. The back-end ratio is a bit higher, typically between 36 and 43%. This includes all your monthly obligations, such as housing costs, credit cards, auto loans, student loans, and any other recurring debts. Underwriters want to see that you have a stable income, a manageable debt load, and enough leftover cash flow after adding the mortgage payment to comfortably cover your expenses. Meeting these criteria increases your chance of loan approval and terms that fit your financial situation. Appraisals are essential because they establish a market-supported value for collateral, which is crucial in underwriting and financing residential properties. There are three main approaches we use in property appraisal and valuation. First is comparable sales, the most common method. This approach looks at recent sales of similar homes nearby to benchmark the value of the subject property. It's effective because it reflects actual market activity. Next is the cost approach, which estimates the value of the land plus the cost to rebuild the property from scratch. This amount is then adjusted for depreciation and the overall condition of the property, giving a clear picture of its worth based on replacement cost. Finally, the income approach is applied primarily for properties that generate rental income. Here, the value is tied to the expected income the property can produce and the returns an investor would seek. Together, these methods ensure a comprehensive and market-supported valuation, which is foundational for responsible underwriting and financing decisions. On this slide, we're focusing on the process of title search and insurance, which plays a crucial role in protecting property ownership and ensuring a smooth transaction. First, the title search involves reviewing public records to check for any liens, judgments, easements, or breaks in ownership. This step is critical because it helps identify any issues that could affect the property's title. Next, once any outstanding claims or problems are identified, they must be resolved before the property can be financed and legally transferred. This ensures the title is clear and free from encumbrances that might cause trouble down the line. Following that, the title company issues a title commitment, which lays out the specific conditions that must be met to provide final insurance coverage. This commitment acts as a promise that once those conditions are satisfied, the title company will insure the property. Finally, the title insurance policy provides protection for both the owner and the lender against any covered title defects that might surface after the purchase is complete. This insurance is essential because it transfers the risk of ownership defects away from the buyer and lender, giving everyone peace of mind. Together, these steps form a vital part of underwriting and financing residential properties. On this slide, we're comparing two main types of loan products: conventional loans and government-backed loans. Starting with conventional loans, these typically require a stricter credit profile. Borrowers who have higher credit scores and cleaner financial ratios tend to get better pricing. Down payments often range from around 3% to 5% for qualified buyers. One advantage is that once enough equity is built up in the home, mortgage insurance can be removed. However, if your down payment is less than 20%, you will need to pay private mortgage insurance or PMI. Conventional loans are best suited for borrowers with strong credit, stable income, and those looking for flexible long-term cost options. On the other hand, government-backed loans are designed to widen access to financing. FHA loans, for example, offer more flexible credit standards and lower down payment requirements. However, mortgage insurance is a significant cost factor in FHA loans. VA loans are available to eligible veterans, offering the benefit of no down payment and no monthly mortgage insurance, which can be a major advantage. USDA loans are geared towards those in qualifying rural areas, often with no down payment required and income limits to ensure affordability. Understanding these differences helps borrowers select a loan product that best fits their financial profile and homeownership goals. When lenders evaluate upfront cash requirements, they look at both the entry equity or down payment and the cash reserves a borrower has after closing. A higher down payment can significantly strengthen your loan approval chances, lead to better pricing, and positively affect mortgage insurance outcomes. Equity at closing is a key factor lenders prioritize. Looking at the typical down payment spectrum, minimum qualifying programs may require as little as 3%, giving borrowers more flexibility, but representing a higher risk for lenders. A 10% down payment shows more commitment and lowers risk, while a 20% down payment is often seen as strong conventional positioning, improving the borrower's standing even further. Cash reserves are equally important. They are the months of housing payments you'll have left after closing, demonstrating that you can handle financial disruptions even after paying your down payment and closing costs. For example, if you have $12,000 in verified liquid funds and your monthly PISHA payment is $3,000, you effectively have enough reserves to cover 4 full months of housing expenses. Keep in mind, lenders often expect higher reserves for riskier borrower profiles or larger loans. This cushion helps ensure you can manage unexpected challenges without defaulting on your mortgage. Understanding both your down payment and your cash reserves is crucial in presenting a strong financial position to lenders. Here, we're focusing on employment and income verification, which is a crucial step in the underwriting process for residential properties. Underwriters look for stable, documented, and traceable income to ensure that borrowers can reliably support their monthly payments. Key documents used for this verification include W-2 forms, pay stubs, tax returns, and offer letters. These documents help confirm that the borrower has consistent employment and reliable earnings. Essentially, this verification gives underwriters confidence that the borrower's financial situation is steady enough for financing approval. When assessing risk and making underwriting decisions, approval hinges on whether any weaknesses are isolated, understandable, and balanced by strengths in other areas. A balanced risk profile can still lead to approval. The decision matrix helps us evaluate key factors across several categories, including credit, income, property, and collateral. For credit, we look at the score, payment history, and revolving credit use, rating them as strong, acceptable, or weak. Income is assessed by stability, documentation, and debt coverage, again categorized similarly. Property evaluation considers condition, occupancy, and marketability, while collateral depends on appraised value and loan-to-value ratio. Importantly, two strong factors can offset a moderate risk in another area. When this balance is achieved, the decision may be conditional approval, reflecting a carefully managed risk in residential property financing. Now, let's walk through what happens after conditional approval in the loan process. It's a staged path that takes us from initial lender requests all the way to the final loan clearance. First, we need to obtain documentation. This means collecting updated statements, letters, and verifications to make sure everything is current and accurate. Next, we address any conditions. It's important to resolve any underwriter questions quickly and thoroughly, so there are no lingering issues. Then comes the final appraisal, where we confirm that the property's value supports the loan terms. This step ensures that the investment is solid. After that, we deal with title insurance. This involves verifying clean ownership and making sure the transfer is insurable, which protects all parties involved. Finally, once all these steps are complete, we reach clear to close. This means the file is approved and ready for the closing documents to be prepared and signed. These stages are crucial for underwriting and financing residential properties, ensuring everything is in order before the loan closes. When it comes to underwriting residential properties, there are several common conditions that must be met before we get to clear to close. Most files are approved with follow-up items that help us confirm important details about the borrower, the property, and the transaction itself. One key condition is payoff letters. These are necessary when outstanding debts must be paid off at closing in order to meet debt-to-income ratios or lien requirements. Debt verification is critical here to ensure everything aligns. Another important area is income support. Additional documentation for income like overtime, bonuses, commissions, rental income, or self-employment income is often required to verify the stability and consistency of the borrower's earnings. We also look closely at asset review. Updated bank statements are needed to confirm that the borrower has sufficient funds for closing, reserves, and that any large deposits are properly sourced to prevent surprises. Property insurance verification is another frequent condition. Before documents can fund, there must be proof of active hazard coverage to protect the collateral. For condos or planned communities, lenders might request HOA documents such as budgets, bylaws, and dues information. This helps us assess the stability and obligations of the community, which is the project review. Finally, a pre-close check often includes a final walk through the property to verify that the condition hasn't materially changed since the appraisal or inspection. These 6 frequent conditions are essential checkpoints to ensure a smooth and compliant path to closing. When we look at how interest rates are determined, it's important to understand that the final rate a borrower receives is really a combination of several key factors. First, Federal Reserve policy plays a crucial role. Changes in the Fed's benchmark rates directly impact lenders' funding costs, which in turn reset pricing across the entire market. Next, market conditions also have a big influence. Variables like inflation, bond yields, market liquidity, and the level of competition all cause mortgage spreads to fluctuate on a daily basis. These market dynamics can either push rates up or pull them down depending on economic shifts. Finally, the borrower's individual profile comes into play. Things like credit score, the size of the down payment, whether the home is owner-occupied, the type of loan, and the borrower's debt-to-income ratio all affect risk assessments and lead to specific risk-based adjustments on the rate. So, when you combine federal policy, market forces, and borrower-specific risk, you get the final interest rate that lenders offer consumers. This blending of macro influences and personal credit factors is what determines the mortgage rates in the real world. Now, let's take a closer look at closing costs and the final numbers involved in a loan transaction. These final figures generally fall into three main categories: lender fees, third-party costs, and prepaid expenses. Starting with lender fees, these include origination fees, which cover the compensation for structuring and issuing the loan. Then there are processing fees, which take care of document collection, file setup, and coordination tasks. Underwriting fees come next, covering the thorough review of the borrower, the collateral, and the overall loan risk. Moving on to third-party costs. These consist of expenses like appraisal fees, which are paid to an independent party to confirm the value of the collateral. Title fees are for the search, settlement, and insurance ensuring clean ownership of the property. Inspection fees may also be included when a property condition review is necessary as part of the deal. Lastly, prepaid expenses involve amounts collected up front to cover various ongoing costs. Property taxes are collected initially to fund the escrow account. Insurance fees cover homeowners' coverage and related escrow deposits. And per diem interest is the interest due from the closing date up to the end of that month. Understanding these three categories helps clarify what makes up the cash to close and ensures borrowers are prepared for the full scope of costs involved when financing residential properties. Now, let's walk through the closing process, which is a crucial final step in the home buying journey. First, we review the closing disclosure, or CD. This is where we confirm final loan terms, the exact amount of cash you need to bring to closing, and all associated fees. It's important to carefully go over these details to avoid any surprises. Next, we move to signing the documents. This includes executing the note, the deed, and the entire settlement package. Signing these papers makes everything official and legally binding. After that, the funds are transferred. This means that the buyer's cash and the lender's proceeds are disbursed appropriately to complete the transaction. This ensures the seller gets paid and all financial arrangements are settled. Finally, the deed is recorded. This step makes ownership and any lender liens official by entering them into public records, securing your legal claim to the property. Understanding each of these steps helps clarify how the closing process legally and financially finalizes the purchase of a home. When underwriting a loan, certain red flags can significantly increase the risk of denial. These warning indicators prompt underwriters to shift their focus from simply validating information to actively containing potential risks. The first major red flag is an unexplained credit decline. If a borrower's credit score drops suddenly, or if there are new late payments or added debts without a clear reason, it raises serious concerns about their financial stability and repayment ability. Next is inconsistent income. When pay stubs, tax returns, or employment records don't line up, it casts doubt on the borrower's income stability, making it harder to trust they can meet loan payments consistently. The third key area is property issues. Problems like low appraisals, concerns about the property's condition, or defects in the title can diminish the value of collateral and may cause a loan to fail program guidelines. Finally, fraudulent documentation is perhaps the most critical warning sign. Altered bank statements, fabricated assets, or documents that can't be verified almost always result in immediate denial and can trigger further investigation or escalation. Each of these red flags directly impacts the risk profile of the loan, and recognizing them early is crucial for protecting both the lender and borrower from unnecessary financial exposure. Let's talk about jumbo loans, which are designed for high-value properties. In 2024, the typical baseline for a jumbo loan starts at amounts above $766,550. Essentially, any loan amount that exceeds the standard conforming loan limits is viewed as a jumbo loan. The key point here is that jumbo loans finance homes priced beyond the local conforming loan caps. Because these loans exceed the typical limits, lenders take on more risk by keeping a bigger exposure on their balance sheets or by selling these loans in private markets. The minimum threshold for a jumbo loan starts above the local conforming limits, and this threshold tends to be higher in designated high-cost markets. Because of the increased risk, jumbo loans come with stricter requirements. Borrowers should expect to make larger down payments, show stronger cash reserves, and have higher credit scores compared to conventional conforming loans. All in all, jumbo loans involve a more rigorous underwriting process and financing standards to ensure both lenders and borrowers are protected when dealing with high-value residential properties. After the loan has closed, the focus shifts from underwriting to portfolio management and ongoing servicing. This means the borrower experience moves into several important phases. First, loan servicing begins. The loan is boarded onto a servicing platform that keeps track of everything: loan balances, escrow accounts, statements, and compliance requirements throughout the life of the mortgage. This ensures that all the details are managed accurately over time. Next, payment processing takes place. Monthly payments are collected and applied precisely to the principal, interest, taxes, and insurance. The system continuously monitors for any delinquencies or exceptions to catch issues early. Finally, borrower support is a key part of post-closing management. Servicers are there to handle any borrower questions, hardship requests, payoff demands, and account changes. This support helps borrowers navigate their loan confidently, providing assistance and resolving any issues that arise. In this way, even after funding, the relationship with the borrower continues with ongoing care and management to ensure the loan's successful administration. Today's underwriting process is much faster and more consistent, thanks to technology that connects core decisions across digital systems. There are four key tools driving this change. First, the connected lending stack integrates different parts of the workflow, making it seamless. Then, automated decisioning uses rules-based models to quickly screen eligibility and flag any exceptions within seconds, speeding up initial reviews. Next, digital document verification allows income, assets, and identity to be validated directly from trusted data sources, reducing manual checks and errors. Credit decisioning engines combine credit data, policy overlays, and risk scoring into a comprehensive view, helping underwriters make informed decisions more efficiently. Finally, e-closing platforms streamline the closing process by reducing friction, speeding up signatures, and improving audit trails, which enhances both security and convenience. Altogether, these technologies are transforming how residential property underwriting and financing operate, making the entire system smarter and more effective. On this slide, we're focusing on regulatory compliance and fair lending, which are essential in underwriting and financing residential properties. First, the Truth in Lending Act requires lenders to clearly disclose key information like the annual percentage rate, finance charges, and terms of the loan. This ensures borrowers receive accurate and timely disclosures, helping them make informed decisions. Next, the Equal Credit Opportunity Act mandates that lenders evaluate all applicants using the same credit standards, promoting fairness. Importantly, if an application is denied, the lender must provide an adverse action notice explaining why, which adds transparency to the process. Then, the Fair Housing Act prohibits discrimination in housing-related lending. This means lenders must treat all applicants consistently, regardless of protected classes, and provide transparent terms to ensure equal access to housing finance. Together, these regulations form the core principles guiding fair and compliant underwriting and financing practices in the residential property market. They protect consumers and promote fairness throughout the lending process. Here we have a case study that illustrates the underwriting process for a residential loan. Our hypothetical borrower is Jordan Lee, a 22-year-old individual with an annual income of $138,000 and a solid credit score of 742. Jordan is requesting a loan of $412,000 to purchase a single-family home in Austin, Texas. The property has a purchase price of $458,000, but was appraised slightly higher at $465,000, which is a positive sign. The loan-to-value ratio, or LTV, stands at 90%, meaning Jordan is putting down 10% as a down payment. The loan was approved, but with certain conditions: a debt-to-income ratio of 31%, a 10% down payment, and at least 2 months of reserves, ensuring Jordan has some financial cushioning. The property will be Jordan's primary residence, which typically carries different underwriting guidelines than an investment property. This example highlights how multiple factors, income, credit score, loan amount, property value, and reserves, are carefully balanced in the underwriting process to assess risk and ensure the borrower can manage the loan responsibly. When a loan application is denied, there are important steps you can take to appeal the decision or explore alternative financing options. First, consider submitting new documents. Sometimes updated pay stubs, corrected credit items, or reserve statements can significantly improve the file and change the outcome. Next, formally request reconsideration. This works best if the denial reason is specific and you've addressed that issue with new information. It's crucial to act quickly because timelines matter. Rate locks, contracts, and the validity of documents are all time sensitive. Even if the original loan path closes, other financing options may still be available. Now, let's talk about alternative products that might help. FHA financing offers more flexible standards when it comes to credit and down payments, which could reopen eligibility. Non-QM loans are another option, using bank statements or alternative income documentation to suit borrowers with more complex financial situations. Additionally, co-signer options can strengthen an application by adding extra income or credit support. These strategies, combined with solid understanding of underwriting requirements, can help navigate the path to financing residential properties successfully. Now, let's look at the key trends shaping residential financing today. The market is moving toward tighter risk control, faster digital workflows, and more detailed property-level scrutiny. There are four main forces influencing how lenders price, verify, and approve loans. First, rising interest rates are making borrowing more expensive. This puts pressure on affordability and leads lenders to more aggressively stress test borrowers' ability to make payments. Second, we're seeing stricter lending standards. Lenders are increasingly focused on verified income, ensuring stable reserves, and maintaining clean, thorough documentation to manage credit risk effectively. Third, remote underwriting is becoming the norm. Tools like digital verification, e-signatures, and automated reviews speed up decisions while still keeping human oversight in the loop. Finally, sustainability requirements are growing in importance. Factors like energy efficiency, insurance risks, and climate resilience now play a bigger role when reviewing collateral and setting loan terms. Together, these forces are reshaping how residential properties are underwritten and financed moving forward. When preparing to apply for a mortgage, there are 5 key actions that can make the underwriting process smoother, faster, and more predictable. First, check your credit early. This means reviewing your credit reports well in advance, correcting any errors, and avoiding any new late payments that could hurt your score. Next, organize your documents. Having all your necessary paperwork ready, like pay stubs, W-2s, tax returns, bank statements, and identification, makes the process much more efficient. Stabilizing your income is also crucial. Lenders want to see consistent employment, so try to keep your job steady and be ready to explain any recent changes in your income. Reducing your debt will improve your debt-to-income ratio, so pay down revolving balances where you can. This strengthens your financial profile in the eyes of underwriters. Finally, avoid making any major purchases before your loan closes. Opening new credit accounts or financing big-ticket items like cars, furniture, or appliances can negatively affect your creditworthiness and complicate the underwriting process. Following these best practices will help you navigate underwriting more confidently and increase your chances for a successful mortgage approval. The timeline from application to funding in the standard residential financing process typically spans 40 to 45 days, or about 6 weeks. It begins on day 1 with the application itself, where you submit all necessary information to start the process. Between days 1 and 3, pre-qualification takes place, which helps determine your initial eligibility for financing. By days 4 to 14, you focus on property selection, identifying the home you wish to finance. Appraisal happens next, between days 15 and 22, where the property's value is assessed to ensure it meets the lender's criteria. Underwriting, a critical step performed from days 20 to 30, involves a thorough review of your financial documents and the property to evaluate risk. Following this, conditional approval is granted sometime between days 28 and 35, indicating the lender's agreement pending final conditions. Between days 35 and 40, you receive the clear to close, meaning all conditions have been met and the loan is ready to be finalized. Finally, funding occurs between days 40 and 45, completing the financing process. Throughout this timeline, progress moves from left to right as documents, collateral, and final conditions are cleared, ensuring a smooth and timely closing within the typical 6-week window. To wrap up, let's highlight the key takeaways from our discussion on underwriting and financing residential properties. First, successful residential financing hinges on the alignment of risk, value, and execution. Each part must work together seamlessly to support a healthy transaction. Second, underwriting plays a crucial role in protecting everyone involved, the borrower, the lender, and the overall integrity of the deal. It ensures that all risks are properly assessed and managed. Third, having clean and complete documentation is essential. Well-organized files help reduce delays and build confidence in the approval process. Fourth, the decision-making centers on creditworthiness and income. Assessing the borrower's ability to repay is the cornerstone of any loan eligibility evaluation. Fifth, the appraisal process establishes the property's value. This step ensures that the collateral adequately supports both the loan structure and current market conditions. Finally, closing the transaction only happens once all conditions are met, disclosures are complete, and funds are secured. This final step confirms that everything is in order and the deal can move forward securely. These points together form the foundation for effective underwriting and smooth residential financing.